falling because our soil, our fundamentals aren't very good. Our harvest isn't very good because we have clay soil. Or our harvest isn't very good because we don't have enough microbes. And the same can be true in the fundamentals of the economic cycle. So the fundamentals can drive the prices down, but sometimes it's just the changes that are happening in the financial markets and the fact that it creates a perception. The stock market, bond market, any publicly traded market is always an indicator of what people perceive the future of that market to be. And that's a judgment. And that's why we don't get into market timing, which is a whole nother, obviously, whole conversation. We could have a whole presentation on that. But so we won't get off track. We're going to go on to, so we have risk. And there's a lot of different kinds of risk. But these two risks, inflation or volatility, are the two risks that for the most part we have to manage in some way. And we have to manage them in a way that's smart enough for us to make our life work in terms of inflation and volatility. So let's look at inflation first. If I take inflation, and inflation is one of those kind of silent things. You know, we don't wake up in the morning and say, well, I better hurry up and buy something because inflation's happening. It's going to be worth, I'm going to have to spend more for it tomorrow. It just sort of eats away at our purchasing power. So, and it usually is in this 2 to 3% range. So it doesn't seem like it's a lot. Now, if I'm looking to the future, I'm thinking we're going to have a little bit more than this. But for this purpose, for right now, we're saying average inflation has been around 3%. And what does that really mean to me? If I have $100,000, at 3% in 10 years, it's worth $744. I've lost 25% of my purchasing power in 10 years. Does that seem like a lot or a little bit to you? It seems like a lot. Yeah, so with inflation, in 20 years, it's $554. I've cut my purchasing power in half in 20 years. So it's not a risk that we can afford to ignore, is it? This is pretty critical stuff, because when we're retiring in our 60s, are we going to live 10 years? We sure hope so. Oops, excuse me. And 20 years. I mean, we're doing financial plans. We used to always plan into our 90s, and now I'm thinking that's not old enough. If you've read some of the futurists, they're saying that we're going to replace all our parts. So, well, just if you can live long enough, you can live forever. It depends on who you read, but of course. But literally, our retirement periods are 30, 40 years. There's certainly more than 10 or 20. So if we are going to maintain purchasing power, we somehow have to manage inflation risk. And here's the antidote for inflation risk. We have to have what I call owner assets. Owner assets, which are large cap stocks, small cap stocks, or foreign stocks, real estate, those kinds of things. And real estate can be privately held real estate, or I can hold publicly real estate, or I can have my own closely held business. These are all owner assets. Now, I differentiate them with loaner assets in that there's no guarantee in an owner asset. If I go into business for myself and I put $10,000 in my business, is somebody going to guarantee that I get my money back? No. I might lose everything. I might lose it all really quickly. For some of us who've been in business, you know how fast it can go sometimes. Or I might make a lot more than the public markets. But there's a substantial amount of risk, but my possibility for making more than inflation is there with an owner asset. If I'm a loaner asset is when I loan someone money. It can be a bond or a certificate of deposit or a money market account. When I open an account at the bank, I'm loaning them my money. Of course, they're going to loan it to somebody else. That's how banks make money. But in effect, I'm loaning them my money. What are they going to give me? Interest. Is that interest more or less than the rate of inflation? Less or about equal. Usually interest rates and inflation rates are about the same. So if I'm going to invest in loaner assets, my return is going to look a lot like inflation. So I can't manage this inflation risk by having loaner assets. I have to have some owner assets, and what do owner assets have that loaner assets don't have? The other risk, volatility. So my antidote for inflation risk leads me into volatility. So how do we manage volatility? Let's look at that one. There is volatility in our investment return. There's volatility in our garden. We have variations in length of harvest, duration. Same thing with, a bull market can be 20 years. A bull market can be 3 months. A bull market can be a day sometimes, it seems like. The timing of when markets are good or bad is very different, and the quantity of our results are very different. So we definitely have, when we're investing in owner assets, which are stocks, foreign stocks, small cap stocks, real estate, commodities, owner kinds of assets, we have volatile, we have changing results. And those are pretty substantial changes. Here's some examples. This is 1997 to 2006. Large cap stocks, fixed income, which now these are owner assets, loaner assets, owner and owner assets, okay? So you can see the variation in return, best to worst. Of course, one of the reasons that people like to buy fixed income investments or bonds is because they tend not to go down as much. They also don't go up as much, and they have a lower average return. But these are some pretty big ranges in it. 33% on the high side, 22% on the bad side. Same commodities, 35% on the upside, 32% on the downside. It's a pretty significant variation. So volatility is a part of owner asset return. Looking at that S&P slide I showed you before and just looking at it from a return standpoint, remember that $100,000 that your uncle gave you? This is just looking at it from a return standpoint. And the red numbers are negative and the black numbers are positive. If you were to write a narrative about that, the numbers up there, what would you say?
Roller coaster?
It's a roller coaster. What else might you say about the numbers on that slide? Most years are black. Most years are positive. Pretty big swing between the low or high. So owner assets, which are our cure for inflation, have a lot of volatility. Okay, so when we look at this, one of the things that's important to remember is the results tend to be positive, and the overall return for this average period is positive. Last year, were people thinking about the fact that, for the most part, the returns are positive? No. Most of the conversations I had with people where they were talking about what? The end is near. It's all over. Everything is terrible. It's like, okay, this is a cycle. We're going to go through this cycle. But it's really hard. What do we do? What do I know about human beings is they remember the most recent economic past. And they remember that as if that is reality. Then that's just the most recent economic past. If we just had a tornado, does that mean we have a tornado every day? No, we just had a tornado. Doesn't mean that it's going to happen every day. But we remember the most recent past. And that's true for investing. And that's where most of us really fall down in our own personal decision making around investments, is we tend to predict tomorrow based on the most recent economic past rather than looking at it as a bigger perspective. So if there's an antidote for inflation, which is to buy these owner assets, and these owner assets give us volatility, we must have an answer for volatility as well, correct? Or otherwise, Mackey's answers don't really make sense. She's got to have both. Well, the antidote for volatility is the very first one. The most important one is understanding our cash flow. If we go back to this slide, if I put all of my money in the S&P 500, that's why I wouldn't suggest you do this, and last year my assets went down 38%, would I be really happy about having to cash in some of my stocks to pay my bills? No, it's not a good time to have to cash in stocks to pay my bills. If I'm going to have equity assets, loaner assets, I'm going to have something else to manage my cash flow. Because one of the things that we know about these markets is they are volatile, but over longer periods of time they tend to be positive. And I always look at 5 years. So when I say understand your cash flow, our rule of thumb is we like to have, as you approach retirement, 5 years of necessary cash flow in bonds and cash to meet your needs. So let's say you're spending $100,000 a year. That's your spending, not your. You may get money from Social Security. You may have a pension. But if you're spending out of a portfolio $100,000 a year, then you need to have roughly $500,000 in cash and bonds. And why do I say that? Because cash and bonds are not as volatile as equities. And if the equities are going down, I can continue to take my money out of the bonds. I can continue to use that for my cash flow. And what will happen to my equities? They'll eventually go back up. If I sell them while they're down, will they go back up? No. I mean, I've had a few people in my office recently who are telling me that they sold last October, and they got out of the market and they went and bought a certificate of deposit at the bank. You know, I mean, it just breaks my heart because they would be almost back to where they were, but instead they've gained 2% on their money since last October. So they lost a chunk, and they haven't stayed in the equity market. So one of the things you can't do is change if that's not part of the plan. The plan will tell you how to invest if you have a good plan. So we have to understand our cash flow. And if we're not using, and that's why when they say, if you're younger, you can have more money in stocks or have more money in equities, because when we're younger, we're not using money out of our investments for cash flow. So it's not so much how old